Breaking news, we're moments away from the ADP report for the month of May. Private payrolls are expected to be up 180,000. As soon as we get that number, we're going to give it to you right now. Going into the number, markets are rallying. Dow Industrials up 137 points. NASDAQ up 49 points. Joining us right now is Portfolio Wealth Advisors President and Chief Investment Officer Lee Munson. Lee, it's good to see you.
You too.
Thanks so much for joining us. So, big rally yesterday and today, obviously, ahead of this number and on the heels of Powell's comments. What do you expect from the jobs picture and the ADP number?
I think people are going to have a good reaction to it. Yesterday, it just shows me that I think people don't really understand the Fed. I think that people still think Bernanke or Yellen are in charge here. Powell's a risk manager. I don't know why everybody was so excited yesterday. He's saying he wants to cut. That's because he's trying to keep the housing market alive. I think it's going to take several cuts to keep that. I think that the ADP number is going to be important. For me, as not a day trader, I'm concerned about the labor markets. We're getting down to the dregs of society now.
What do you mean?
Well, put it this way.
Wow, this is a very weak number. 27,000 jobs were added to the economy in the month of May. 27,000 is the number. We were expecting 180,000, Lee. So this is much weaker than expected. What's your reaction to this number?
I'm not surprised. This is why Powell is saying that he's going to have to cut. And you have to think about it from a business perspective. Unemployment is so low right now. When you have to hire that next marginal person, they're going to cost more, and they're going to be not the most productive people. The most productive people already have jobs. So I think that that's a big thing that's causing what traders call overhead supply, which is a fancy jargon for there's a lot of stock that people aren't willing to pick up right now. I think that's going to continue, and I think this is the type of catalyst that could cause a summer correction where people like me want to sell some bonds and buy some stock. And so, if we could see the S&P down at 2650, that's not some big deal, but that's where I'd really lock and load and start.
Well, were you doing that in the month of May, though? Because, again, the NASDAQ was down, 8%? Dow Transport's down more than 10%. I mean, it was a rough month. So were you adding to your stock allocation when stocks are falling?
I was buying a lot in December, and I was taking risk exposure off at 2,800. So in March, I was already doing my profit taking. So we're still here. So in May, I really need the market to see more of a 10% correction for me to buy for clients. And so it wasn't that May was May was just not interesting. We didn't go down enough.
We had a 10% correction in tech stocks as of Monday's close.
You know what? I'm a .com kid. That's when I started in the business, so tech isn't really the place where I'm buying.
Where would you be buying if markets did get to that, say, 2650 level? What do you think could be the best opportunity? Obviously, you need to see it's time and price. But where, if it's not tech, where do you think you might see the opportunities?
I think that you want to see some broader base indexes. I don't really feel there's a particular place that I need to go hunting for. But I'll tell you one thing that I don't want to do. I don't think that investors need to be necessarily looking for defensive plays right now. I think the trap for people, outside of just saying 2650, buy some S&P exposure, is you see a lot of chatter now about buying these consumer staples and these high dividend plays. And I think that that's a real trap because people, in essence, they're just sort of like trying to buy for yield or trying to buy bond substitutes. I think if you like high beta stuff, you should look at tech. I think if you saw tech go down 10 or 15%, that's just a high beta play of what I'm doing.
Yeah, but we have to talk about the Fed here. Look, the 27,000 increase in jobs is much lower than expected. The Federal Reserve yesterday, Jay Powell, sparked a rally because he said that they are ready. They will be at the table if the trade war escalates and that the Fed needs to cut interest rates. That sparked the rally. A number like this leads to you to believe things are slowing quite a bit. It's only one number. It's only 1 month. It's the ADP. We get the Labor Department number on Friday. But still.
You just remember Jay Powell's words yesterday. What did he say? He said, we will act as appropriate to help sustain economic growth here. That's exactly what we're talking about here. If this number is a real indicator of what's going on, what do we need to sustain job growth? What do we need to sustain economic growth overall?
Or is this a one-off? Is this a one-off, David, or is this something that's changing the conversation?
I don't think it's a one-off. And also, another thing that Powell said, which people kind of forget, and it's the one thing I have it on my whiteboard, is he said, listen, when the federal fund rates start getting ahead of the 10-year Treasury, it means your policy can be too tight. And it is. And it would take 2 Fed cuts to do that. So, again, just like in December, just like yesterday, I think a lot of people are misreading the Fed. And I'm one of those guys that's like, oh, don't watch the Fed all the time. I've been watching the Fed since December like a hawk, and I think it's really telling that a guy like me who's always, forget about that stuff, suddenly I'm interested.
Are you saying you think the Fed's going to cut rates?
Yes.
This year?
Yeah, I think it is. And we had a 20% consensus of a rate cut like a month or so ago. It's popped up to 60. I think we should pop it up to, 100%.
No, it is at 100%. A rate, the consensus for a rate cut is north of 90%.
Well, after
The markets, that's right.
Yeah, after
Fed Fund
yesterday.
future. No, before yesterday even. The markets were pricing in the possibility of a rate cut. It was by the end of the year, it was north of 90%.
Well, Brian Moynihan did not believe that. This is what he said to me yesterday at the New York Economic Club. Watch. Will the Fed cut rates this year? What does your gut tell you? Don't tell me what your economist says.
I don't think they will.
You don't think they will?
Unless something goes really wrong in the trade, I think the economy is stronger than people think. And that's personal belief, so you can take that with a grain of salt. But I'm telling you that unless something goes really wrong and confidence breaks and unemployment breaks, this economy is going to move along in the 2% plus growth rate, and they're raising rates when we're at this growth rate.
Meanwhile, the smallest jobs gain since the expansion began in March of 2010. So this is a serious decline or a serious pullback from what we've been seeing, up 27,000. The estimate was up 180,000.
Yeah. Well, again, this is why I think we're seeing, again, that jargon, that overhead supply, that inability to break out past 3,000 on the S&P. And I think that if we look past just day to day to day and this bounce from the May declines, I mean, May was bad, but it wasn't huge.
It's interesting what ADP is saying, that labor shortages are impeding job growth, particularly at small companies. ADP is also saying that layoffs at brick and mortar retailers are hurting. You've seen a real mixed story in the retail story, and the brick and mortar has been hurting.
Look at GameStop. Look at GameStop.
Yeah.
Look at what's going on there. Look at Tiffany's yesterday getting hurt by tourism being down. There's a lot happening here. There's a lot of cross currents. And don't forget, a number like this ADP, it's going to mean that bonds are going to rally, stocks going to get some pressure. So, to what Lee said.
Lee Munson, good to see you.
You too.
Thanks.